Hello everyone, my name is Ranti Retnowulan with NPM 234122021. Here I will explain about consolidation in a fully owned company, especially in companies that are wholly owned or 100% owned by the parent company. Why is this important? Because in the business world, often one company owns another company. In financial statements, they cannot be separated just like that. This is where consolidation is needed at SO. What is consolidation? Consolidation is the process of combining the financial statements of a parent company and its subsidiaries into one combined financial statement. The goal is for the statement to reflect the financial condition and performance of the business group as a whole, as if they were a single entity. In the case of full ownership, it means that the parent company owns all the shares of the subsidiary, so there are no non-controlling interests or outside parties to report. For example, PT Indic buys 100% of PT Anix shares. Then PT Anix is no longer presented as a separate entity, but becomes part of PT Indic's financial statements through the consolidation process. Now let's discuss how the consolidation process is carried out. In general, there are several important steps. 1. Eliminate reciprocal balance if there is an intercompany transaction, such as receivables from the parent company to the subsidiary company. Then this balance is written off so that it is not recorded twice. Likewise, intercompany sales must be eliminated, so as not to duplicate income. 2. Eliminate children's investments and equity. When a parent company buys a subsidiary company, the investment is usually recorded as investment in subsidiary. At the time of consolidation, this investment account is written off against the subsidiary's equity accounts, namely paid in capital and beginning retained earnings. Since the ownership is 100%, the entire subsidiary's equity is eliminated in full. 3. Adjusting retained earnings. Retained earnings in the consolidated statements is the combination of the parent's retained earnings and the subsidiary's net income after acquisition, less intercompany transactions. 4. Combining assets and liabilities. All assets and liabilities of the child are combined with those of the parent, without any restrictions, because no outside party owns shares in the child. Although it seems simple, there are several important things. Don't forget to eliminate transactions between parties. This often occurs in real financial statements such as purchases of goods or loans between companies. Goodwill can arise if the purchase price fair value of the subsidiary's equity. Ensure that the data used has been adjusted to fair value at the time of acquisition. Strategic benefits of when consolidation isn't just for accountants. Management, investors, regulators, they all use these reports to assess the financial strength of a business group as a whole, determining the feasibility of loans, investments, mergers, and IPOs. Comparing companies in a fairer way. With consolidated reporting, we no longer see bits and pieces, but the big picture of a corporation. Consolidation of financial statements in a wholly owned company is the process of combining the statements of a parent and a subsidiary whose shares are wholly owned by the parent. Since there are no non-controlling interests, all of the subsidiary's earnings, assets, and equity become the full share of the parent. The main steps of consolidation include: combines all asset, liability, revenue, and expense accounts. Eliminate the parent's investment account in the child against all of the child's equity. Delete all intercompany transactions to avoid double recording or false income/expenses. Consolidation goal. The purpose of consolidation is to present one integrated financial report. Economic of the group. Individual financial, honest, accurate, which reflects the economic reality of the business group as a whole, not just individual entities.